Hello, everybody. Chapter 8, Budgetary Planning. Very short chapter, very short. Just a couple of things. Learning objective 1, describe how and why organizations use budgets. Number 2, what are the major components of the master budget? And then number 3, what are the different budgets that get prepared? We're not going to do anything with numbers in this chapter. So these are all concepts and principles related to budgeting. And if you look at this objective 3, this takes you through the order in which budgets are actually prepared. So let's get started. Levi Strauss is the company that they're using as an example. But we talked, I believe it was in the last chapter, we talked about the steps that a business uses, the approach a business uses to solve problems. You know, they have to first define what the problem is, and then they have to look at a set of alternative outcomes. They analyze the pros and cons of each outcome. They choose one, and then they monitor the results in case they have to make any changes, right? And the example in the book talked about you are looking for a place to live, and you've got a choice of either renting a one-bedroom apartment by yourself or going in with other people on a three-bedroom house, right? And we saw the way that worked out. And then we looked at IKEA. It was an example, if I remember right, about outsourcing the food service, right? So we had to look at the different alternatives and decide which way to go. And this is kind of just an extension of that. The only difference is that with a budget, you're taking the decision factors, the plans, and you're expressing them in financial terms. So we talk about planning in a business context, looking forward, looking into the future, and setting goals and objectives for the company to hit. And then we come up with a plan. We put the plan into operation. That's called implementing. And then controlling means we need to go back and constantly review the results to make sure that we're going to meet the goals, and we may have to make some adjustments to the plan. So how does this all relate to budgeting? Is that the budget is the plan expressed in financial terms. They talk about the difference between long-term objectives and short-term. Budgets tend to look short-term, and again, in accounting, short-term usually means a year. And we can get very specific with a budget. We can take a long-term view, maybe look out 5 to 10 years. But when we do those long-term plans, they tend to be very general, very broad. They're not specific like a budget is. A lot of times what you'll do is you'll start out with your budget for this year, right? And then you'll just keep looking forward. You'll make assumptions. You'll say, well, gee, you know, if our sales keep going up the way they are, where are we going to be 5 years from now, 10 years from now? Our costs are also going to go up. And we just kind of project long-term what's going to happen. So here they talk about what the benefits of budgeting are, is that it really forces management to look ahead, right? Because a lot of times you can get mired in the day-to-day things that go on in your life, and you kind of, you know, you don't plan, and that's why people very often run into problems. That's why people work their whole lives and wind up with no money to retire, and other such problems, right? So the biggest benefit is looking ahead, thinking ahead. Another benefit is communication. We want people, the employees, everyone in the organization to know what's going on. Not every little detail, but we want them to know so that they can see the role that they're playing in our organization. And in doing that, we can promote cooperation between the different departments within a company. Some companies, it's very competitive, and the departments, a lot of times the people don't get along. But we should try to do things to prevent that. And a good budgeting plan can do that. And motivation, well, let's see, motivation. We can use the budget to evaluate the employee's performance, right? If the department has a goal, a target that it has to meet, and it doesn't meet it, right? And it turns out to be the fault of the people that work in that department, right? Well, then maybe they need to be told that. By the same token, if they achieve the goal, if they hit the targets, they should get bonuses and be compensated for that. So when we talk about the behavioral effect of budgets, that has to do with the motivation, right? We want people to hit the company's goals, our employees. What else can we say here? We should strive to have something called participative budgeting. Participative budgeting means that we want all the employees to have some input in the budget process. It's a bottom-up approach rather than a top-down approach. A top-down approach, the management sets the budget and they force it on the employees. And that's not a good thing, right? So it's probably the way it works out in reality most of the time. It's somewhere in between. We want to encourage the input of the employees. We want them to participate, but by the same token, management sometimes has to do the things that management does and make the tough decisions that need to be made. See, a lot, they talk about something here called budgetary slack, building fat into the budget. And a lot of times, you know, the employees might try to do something like that because they don't want to make a budget that's going to be too difficult for them to carry out. So they tried to build a little extra into the budget, little extra money to spend on different things, and so on. Okay. All right, so enough said about that. Okay, now master budget. The master budget is a set of all the budgets that cover the company's operations. And, you know, we know what a balance sheet and an income statement are, right? And what they look like. So we have a budgeted income statement and a budgeted balance sheet. So what's the budgeted income statement made up of? Sales, cost of goods sold, selling and administrative expenses, net income, right? Those are all the things that go on a income statement. Budgets have to start with a sales budget. A sales budget, we go to the sales department, the marketing department, and we ask them, what do you think you're going to be able to sell? How many units of product are you going to be able to sell? Once we come up with that number, all the other ones fall into place. Now we go to the production departments, the manufacturing department, and we say, okay, we're going to sell 1 million units of product. What's it going to cost for you to make that? What do you need in materials? What do you need in labor? What do you need in overhead? Right? And then we go to the other departments to find out what they think they're going to need to spend on selling and administrative costs. Now, when we talk about the budgeted balance sheet, right, we need to budget cash receipts and cash payments. In other words, how much cash do we think is going to come into the business based on those sales, right? How much cash do we think is going to come into the business? And how much cash are we going to need on all these different expenses? Budgeted cash payments. That's your cash budget. Budgeted cash receipts minus budgeted cash payments makes up your cash budget. Now, what about the other parts of the balance sheet, right? Because when I'm talking about cash receipts, I'm thinking in the way of cash and accounts receivable and maybe even inventory. Budgeted cash payments, I'm thinking about paying the bills. But what about the longer term assets? What about the property, plant, and equipment? Those are called capital expenditures. So what does the company need to spend on capital expenditures? You know, we have equipment, maybe some of it's new, maybe some of it's old. Does any of it need to be replaced? If we're going to replace it, how much is that going to cost? Are we going to expand? Do we want to open more offices? Do we want to go into different foreign markets? Do we want to acquire other companies? Right? These are complicated questions. And these are what are called capital expenditures. So that's how we wind up with the budgeted balance sheet. Budgeted income statement versus budgeted balance sheet. Right? And then it goes on for a few pages going into some details about that. I urge you to read that. And we're about to get to the homework, but before we get to the homework, one of the homework problems that we're going to do, right, I'm just going to give you a hint. The second homework problem we're going to do. Here's your answer. So what order do we need to prepare? What are all the different budgets, first of all? In what order do they get prepared? Here it is. So here's your answer to the second homework question. So we're going to get to that now. Go. Okay, we had exercise 2. Oh, it's not blowing up. We're going to get exercise. We're doing exercise 2 and 3. Exercise 2 is a fill-in question. And then exercise 3 asks you what are the order in which the budgets are prepared. So why don't we do number 3 first, right? And like I indicated to you, to answer that question, the simplest thing is just to go look at that page in the textbook, which explains the order in which the budgets are prepared. Remember, that was page, in the book, it's page 350. Right, so if we look at exercise 3, where are we? Exercise 3 is on page 380, right? Classifying, ordering components of the master budget. Organize the following budgets in order of preparation by placing the number before it. Indicate how each budget would be affected by a sales forecast that is overstated. I don't think we have to answer that part of it, but just use your imagination. If the sales forecast is overstated, then all the other numbers are going to be overstated. Okay, so number 3. Right? What's the order in which they're prepared? Well, the sales budget comes first, right? Number 1. The production budget is second, that's number 2. Within the production budget, you have what? You have direct materials, direct labor, and manufacturing overhead. That's number 3, number 4, and number 5. Next comes the budgeted cost of goods sold, right? Because when you add all of those things together, you get the budgeted cost of goods sold, number 6. Selling and administrative expenses, number 7. And those are all the items that go on the budgeted income statement, right? Now, as far as budgeted balance sheet goes, we want to forecast the cash budget, which is number 9, right? And then next would come the budgeted balance sheet, number 10. So just look at that page, 350, and just go in the same order, and you'll get it, right? Now, question number 2, we have to fill in the blanks. using terms to complete the sentences about budgets, right? And they give you quite a few there, but I don't think you need to use them all. Number one, the master budget is a set of interrelated budget that constitutes a plan of action for a specific period, right? That's number one. Number two, the operating budgets establish goals for the company's sales and production personnel. Number three, a participative approach to budgeting is more likely to motivate people to work toward an organization's goal rather than a top-down approach, right? So you had two answers in number three. Number four, managers who intentionally understate expected sales or overstate expected expenses are creating budgetary slack. Number five, comparing actual results to budgeted plans is an example of management performing its control function, right? We're comparing the budget to the actual, and then we may need to make adjustments. Number six, the starting point for preparing the master budget is the sales forecast. Number seven, the budgeted income statement provides information about a company's expected revenues, expenses, and profitability. Number eight, using a rolling budget, when one budget period passes, another is automatically added at the end. Number nine, the budgeted balance sheet provides information about a company's expected financial position at a specific point in time. Whenever you see those two words together, financial position, 99 out of 100 times, they're talking about a balance sheet, financial position. That's another name for a balance sheet. In some books, they call it the statement of financial position. And number 10, once the production budget has been prepared, the direct materials purchases, the direct labor, and the manufacturing overhead budgets can be prepared. So that is it for chapter 8, right? Nice, simple chapter, no numbers. Chapter 9 is next, and chapter 9 is the end. We will be finished.